Good afternoon. We can start today. So this afternoon, it's a pleasure here to have here Professor Rick van der Ploeg. And I remember that we are in the list of our seminars. The seminars are called Economic Modeling Seminars. And we started in December with Professor Pindijk, after we had Professor Hill. After we had in December, to finish December last year, Professor Zwarte, and we restarted with Professor Richard Toll. After we had Professor Nick Bergman, and the next was the last our seminar was with Professor Christian Gaulier. And today we have a pleasure to have here Professor Rick van der Ploeg, that I will present a little bit in a while. The next seminar will be the next week with Professor Gerlag, again on Thursday in the same hour. And the last of this list of seminar will be Phoebe Kuduri on April 8th. And I remember that this list of seminar is organized by Italian Association of Environmental Resource Economists, with the University of Brescia and the Fondazione Enrico Mattei, in collaboration with the European University Institute, Università di Siena, University of Siena, the Department of Environmental Science and Policy of University of Milan, and the Department of Economics and Management of University of Padua. This list of seminars is a manner to gather all the most important economists in the world on political economy and energy and environment, speaking about uncertainty, social and welfare effect and social welfare system. This is a road, is a pathway in order to converge to the IARE conference. This next conference will be held in April between 21 and 23. This is our poster that represents exactly which is our next conference, the Italian Association of Environmental Resource Economists, and will be held formally from University of Brescia and Fondazione Enrico Mattei, with the support of the list of support that is possible to see there, and also the sponsorship that will be in Brescia and also in Milan the next April. In the next conference, we will be two keynote, very important keynote speakers. The first will be Professor William Rudhaus, Nobel Prize 2018. The keynote lecture will be April 21 at 4 o'clock, and also the 22 of April, Professor Robert Pindijk at 4 o'clock Italian time. Today we have a pleasure to have here Professor van der Ploeg. Professor van der Ploeg is a professor of economics, University of Oxford, and is also a research director of Oxford Center for the Analysis of Resource-Rich Economists, and is also university professor, environmental economist at University of Amsterdam. About his research, the topic is macroeconomics, public finance, natural resource and environment, climate change and development economics. He is also former chief financial spokesperson in the Dutch Parliament between 1994 and 1998, State Secretary of Education, Science and Culture of the Netherlands 1998 to 2002, and elected member of Vice Chair of UNESCO World Heritage Committee between 2002 and 2007. He is also elected member of the Royal Holland Society of Sciences and Humanities, corresponding member of the Royal Netherlands Academy of Arts and Sciences, fellow of the European Economics Association, and an elected member of Academia Europea, among other things, because I have chosen a little bit the most important things in the very long CV of Professor van der Ploeg. About his research, I searched in his CV. There is a longer list of papers that are around 170. Among them, we can collect about the European Economic Review, Energy Economics, Journal of Public Economics, Journal of Environmental Economics and Management, Journal of Development Economics, Economic Journals, JDC, and many others, because I also in this case I collected a list. books, 21 books, among them taxes and the economy, and more specific on our topics are climate policy and non-renewable resources, and the economics of resource-rich economies. That is, I think, the last book that is published so far. So, according to the international ranking, is among the top 5% of authors. It ranks in the top among energy economics, environmental economics, and resource economics. So it's a pleasure to have here Professor van der Ploeg, that I thanks a lot because it's an honor. Now I leave the floor to Professor van der Ploeg, and thank you again.
Thank you very much for this very long introduction. Makes me look very old, which is probably what I am as well. There we go. So I'm going to talk today about, if you want, the political economy of carbon taxation. I spent about 12 years of my life as a politician. So I was a member of parliament. I was also in the cabinet as a ministerial role, and I remember that there were two taboos, at least in Dutch politics. The first one is not to say that you want to abolish the Queen or the King. Then immediately in the elections you go down because they're very popular. But the second thing is, if you suggest anything like a carbon price, then immediately the day following, the newspapers will open and they'll say, Rick van der Ploeg is the guy who's going to try to steal your car away. And it's like political suicide. So we really have to think of a way where we kind of can, if you want, make carbon taxation, make climate policy acceptable for the large majority of people. So I'm going to speak to the yellow vest movements. I'm going to look at things of using the tax revenues of a carbon tax to make them the way that it's attractive enough to get a political majority. So more generally, I want to speak. I mean that part, the majority of part is of the talk is based on a paper with Armin Razai in Vienna and Miguel Tovar from Ireland. But it's part of a more general program where we discuss obstacles to successful implementation of climate policy. So if you want, it's the political economy, or the agenda is the second best policies for climate policy. So I'm trying to think. I can't. Oh, there we go. So I'm trying to look at obstacles to pricing carbon. So I'm going to look at the bottom bit, which is the adverse distributional aspects of carbon tax. That's the topic of today. But there are many other topics. So you will have heard, if you do any international economics, that you will have heard of carbon leakage. If only some of the countries price carbon, some of the burden is shifted to producers depending on the tax incidence. So that means that countries who don't price carbon, they certainly benefit from the lower producer prices of oil. So they have lower oil prices and they're going to have a big party. They're going to increase emissions. That offset is called carbon leakage. So there's a whole literature on the political economy on getting as many people on board as possible. Indeed, William Nordhaus has a nice paper in the American Economic Review 2015 where he talks about climate clubs. I did a lot of stuff on the green paradox, which I will talk about in a minute as well, and about vested interest and lobbies, and about climate skeptics. So the vested interest in lobbies is that many good plans for climate policies are frustrated because of the vested interest of the fossil fuel lobby. Think of the whole topic of stranded assets. So and think of the ideas of rent seeking, think of the idea of lobbies trying to say do not go green because we still have those. And of course, Trump was captured by the coal lobby. But there are other government failures to do with government picking winners when governments don't really have any knowledge of detailed renewable technologies. So I'm going to talk a little bit about two little things and then we go on to the main topic. So this idea of green paradox has to do with procrastination. So politicians are, and it relates to the big topic of today. Politicians are known for two things. One is that they procrastinate. They want to postpone things. So you say, yes, I'm in favor of carbon pricing and I'm in favor of stepping up climate policy, but my successor is going to do it. And the second, so we all do it. I mean, like every year in January, I buy my gym membership. I pay about £500 a year. I go 2 times, and then I don't go again at all anymore. That's why I look so terrible. But normally, but I could have just paid £6 a time, and then it would have only cost me £12. So the idea is we do things which look good at the moment, but then we regret them later on. So that's called procrastination. So we often use hyperbolic discounting for that or things like that. It's the same thing with the gym. It's the same thing with eating fruit and chocolate, like the things I've given you on the diagram. I'm trying to see if there's a way of getting rid of this thing here, but anyway, I can't. Maybe if I click on here. No. Anyway, so then, so talking a bit about green paradoxes, I started with this Hans Werner Sinn, but there's a whole lot of literature. But the point what I want to say here, just before I move on, that if you delay it or if you use subsidies, that's another thing politicians do. They hate taxes, but they love subsidies. Then in the end, that's basically a signal to gas producers and oil producers to pump out the stuff more quickly out of the ground. So they're going to pump it up really quickly, and they're going to have a race to burn the last ton of carbon. So what's going to happen is that if you delay your policies, if you procrastinate, or if you use subsidies like the Germans did, they had these huge solar subsidies instead of using the carbon tax, then what's going to happen is that the fossil fuel producers are going to take the stuff more quickly out of the ground. They're going to sell it. So that means you're going to accelerate oil production and accelerate emissions and accelerate global warming. So that's basically the green paradox effect. That's particularly strong when the supply of oil reserves is not very price elastic. So you can see it here in a model. So here, the green thing is when you have these carbon taxes. Here you see the hoteling rents. So when you're doing a proper policy, you're trying to get these hoteling rents really down from this big curve to the small curve. But then, of course, when you have a second best policy and you just do only a subsidy as the red line, then it works reasonably well. But look, the red line is above the business as usual line. So you get excessive emissions. You can see that even better here. If you look here, then you look at the fossil fuel use. The first best is the light green one. So you immediately switch out of fossil fuel in about 30, 40, 50 years. This big line is the business as usual, but the red line is above it. So the second best policy where you have subsidies, but you don't price carbon, lead to an excessive use of fossil fuel use, and that's called the green paradox. Okay, and then a little word, and then I start the paper proper. Is climate skeptics? It's no longer an issue. You could have argued because Trump is now gone, and we've got Biden and Kerry. That fills me with enormous pleasure. But even if the best argument against climate skeptics, and then I start the political economy proper, is to compare it with this Pascal, Blaise Pascal, the gamble he said. He said, you better believe in God, because the cost of not believing in God when he exists are so incredibly high. You have to go to hell and things like that. Whereas the cost of believing in God when God doesn't exist means you have to go to church once a week or something like that. It's not too bad. So he says, however small the probability that God exists is, pi, you will always choose to believe in God. I mean, unless, of course, you're a true atheist, and then you will never believe in God as an axiomatic given. So, and the same argument is true, I would argue, for climate policy. So if you talk to a real skeptic, you say, look, okay, we're not sure whether you're right or the IPCC is right. I think the IPCC is right, and maybe 99% of people think so. But then you could argue, imagine if we didn't do anything and the IPCC is right, then temperature goes up to 4 degrees and we're all toasted, and the costs are colossal. Whereas if we are taking action, and Trump is right, the deniers are right, so we're pricing carbon, well, because we're rebating the stuff. The cost of carbon taxation is just a Harberger triangle. It's not very much. It's just a little welfare loss. So it's nothing compared with the losses from global warming if the IPCC turns out to be right. So by same argument, you would argue that climate deniers would go for it. So another way, if you do this in a model context, you have the science and the deniers, you can do this payoff matrix. and then you see whether you maximize the minimum wealth, which is the maximum policy, you would price carbon, or when you minimize the maximal regret, you would price carbon. So another way of putting it is, if the deniers hold the correct views, if that's 0, you in the DICE model you would price carbon at. If it's 10%, there's a huge probability that you say that Trump is right. You still price carbon at $19. And when they're 20% right, nobody will believe that. Then you will still go at $17. So what I'm arguing is, because of the way these regrets work out for when you're doing the wrong policy, when actually the IPCC is right, or when you're doing the wrong policy when Trump is right. If you compare those things, then you look at the regret, or you're doing a max-min policy, you will also always price carbon very strongly. Okay, so let me now move to the main part of the paper. And the main part of the paper is about the yellow vests. So suddenly there was this huge protest in France. And the protest in France occurred because it was seen to be, and here you have them again, it was seen to be a policy against the people. So the carbon pricing thing was seen to be a thing for the middle classes. And people would ignore the fact that it would hurt lower incomes much more than it would hurt rich incomes. So the suggestion was that maybe the carbon tax was regressive. And many of those people would argue, well, even if it's not regressive, it was felt to be regressive. I will come to that in some detail at the end. And maybe it's also that because poor people, they're stuck in badly insulated houses and they can't really save energy, or they have these older cars which are very energy intensive. So it was seen to be a real equity issue. It was the people against the elite, and that's really what my the paper with Armand Rezai and Miguel Tovar is all about. So there were lots of protests, and you could see, of course, there was already the percentage here is shown, the percentage of the retail price already paid in taxes. So if you look in Italy, 64% of the retail price is already paid in taxes. This is for oil and gas, but for petrol, and for diesel, it's about 58% is already taxes. So if that was seen to be put up, people get very upset. So let's get a bit more technical. So what I'm going to want to do is to first, I'm going to argue the demand for consumption goods varies non-linearly with income. So many people have assumed that the demand for, say, electricity or transport, or all these different types of commodities. I've seen various integrated assessment studies where they've assumed linear angle curves. So, but no, they are quite non-linear, and they vary, and I will show that. And also you need to capture all the own price effects and the cross price effects. So we're going to capture those effects. We're going to estimate a very, very flexible demand system, which is based on the paper by Lubel and Pendecoeur in Journal of Political Economy. And it's called an EASI demand system. So for those of you who don't know, it is a more general version of the almost ideal demand system, which was at one point done by Angus Deaton and John Mühlbauer. We're going to do that on German. It's a very flexible functional form, and that allows us to really capture the data quite well. We're going to apply that to a panel of German household data. We're going to estimate a labor supply schedule using also hours data and wage data. And we're going to make use of the German income tax schedule. And then we match all that stuff with emissions data with households' consumption bundles. And then we're going to show you some simulations. We're going to simulate the effects of a carbon price of 100 euros. Sometimes it's 50 euros. And then we look at what do you do when you use the revenue to give to the general budget, use the revenue of the carbon tax to give a transfer, a dividend. This is what's often been advocated to overcome the protests on the street, or when you give it to lower income tax rates and boost the economy. And I will also say something about what if you do to use it to maximize political support, or when you do some optimal policies, optimal recycling. So I will look at all of that stuff as well. So a little bit of a preview. Using equivalent variations as a measure of welfare, we find that transfers, so using the carbon tax revenue to hand them out as transfers, leaves 70% of the people worse off, whilst a more clever income tax reform makes the majority of households better off. So we're arguing that if you give all the revenue back in terms of dividends, and many people have advocated that, it's actually bad. And why is it bad? Because by giving the transfers rather than lowering income taxes, it's scores very high on equity, but it scores very low on efficiency. So people are going to work less hours, and by working less hours, going to be less employment, and therefore the Chancellor of the Exchequer, the Minister of Finance, sees the income tax base shrinking, and therefore it gets less tax revenue. So we're going to talk a little bit about rural-urban divides and whether single households or households with children, and because there's some differences there as well. So when you do these type of studies, it's important to distinguish horizontal equity and vertical equity. So horizontal equity, looking at different incomes, but also different types of people with the same type of income. So the motivation is there was a huge policy ambition, and there is a huge policy ambition led by my friend and colleague Frans Timmermans, who is the commissioner driving this. And I want to get it down to, he's got this big green plan for Europe. But when you read it, it's all about pricing uses of fossil fuel. It's all about huge green investments. They talk a lot about a just transition, a fair transition. But if you then look at the reports, the wider considerations, the potential impact of distribution, the potential distributional impacts are not there at all, and they're not part of the thing there. And yet, I think it's crucial. So green tax reform is unpopular because it hurts the poor much more. It's true. That is, so I am not taking a lifetime perspective. So I'm looking at in a particular year. But if you take a lifetime perspective, it still hurts the poor more, but not as much. So these proposals of the carbon tax cum dividend policies try to maximize the political viability of climate policies. So they hope that it makes the regressive policies progressive, and it will benefit the poor disproportionately and lower inequality. However, that's true, but it also, as I already said, it reduces efficiency, and therefore it might actually be worse off. So to give an example, this is a famous study in America used by politicians, by Horowitz et al. They find that 70% of people are better off if you have a greenhouse tax of $49 per ton of CO2, and you rebate it fully as a lump sum of $583 per person, per household, if you want. We argue that we get exactly the opposite. 70% of people are worse off. And that's because most of these studies don't take account of the endogenous, the behavioral reactions in terms of demand and labor supply. So we argue that such a CTCD policy is not feasible. Once you take account of endogenous labor supply and endogenous tax base, and you take account of the endogenous demand for different commodities. So there's a huge literature. I won't talk too much about it. So there's this whole big thing on incidence of carbon taxes and revenue recycling. So there you see a lot of names, and it goes on and on and on and on. So our contribution is really to look at the political economy, and we do also look at some optimal recycling. I don't think any of that has been done. So there's an older literature where an earlier version of myself in the early 90s worked on in a double dividend. And that was mostly homogeneous agents. And there the argument was to show, look, if you have a carbon tax and you use the revenue to cut taxes on labor, then many people believed at the time that then you would kill two flies with one stone, so that you would boost employment and you will improve the climate. What we show there that that's typically not the case. Typically, you will not boost employment. You will improve the environment, but you will not boost employment unless you're very, very, very far away from an optimum, or unless you can shift the burden of taxation. If you can shift the burden to sitting ducks, so maybe retired people, unemployed people, things like that. But on the whole thing, the double dividend hypothesis was that there is no double dividend. You can't get extra jobs and extra. There's no free lunch. You can't get a greener climate and extra jobs. So some of this stuff is doing this again in a more framework where there are lots of different types of households. So one of the things we are not going to do, just because of lack of time today, is that there is a thing called the Corlett-Hague motive. So we're going to assume that labor supply is weakly separable from the utility function. If it isn't, you can look at the cross-price elasticities between, say, gasoline and leisure. So typically, you find that cross-price elasticity suggests that these chaps are complementary. So what that means is that if you increase the carbon price, you reduce the demand for gasoline, but you also reduce the demand for leisure because they're complementary. But if you reduce the demand for leisure, then you're boosting labor supply. So you're boosting the labor income tax base. So then suddenly governments find it really, really attractive to tax carbon because you're taxing carbon not only for the environment, but also because it's such an extremely good way of raising public revenue. So in those cases, it is a Corlett-Hague type of argument to put the carbon price way above the Pigouvian level. So I'm abstracting from that. I'm not saying it's unimportant. I actually think it is important, but it just, the time will not permit me to do it if I want to make the other points. So the model I have, but it is a modeling seminar, so I thought I'd put down some equations. So here's a household budget constraint. This is their wage income. This is a complicated tax schedule, the German tax schedule. This is wage income, household age. This is other income. And then this is other income. And then these are some transfers from the government, which they get if they transfer some money. The residual measure of residual income progression, RIP, is basically 1 for a neutral tax, but it's less than 1 if the marginal tax rate exceeds the average tax rate, if TM exceeds TA, and then you will have a progressive income tax. So the lower the RIP, the more progressive the income tax system. So households work LH hours, they get a wage WH, and that's their tax system. So this is their indirect utility function. So this is the utility cost of this utility of working. They don't like working. This is this utility of aggregate emissions. So this is the emissions cost, and this is the indirect utility of the consumption bundle. So it depends on prices Q. It's a factor, hence the arrow, and it depends on the income of the household. So this is the total, the overall utility function of the household. So what you then find is, so we're going to kind of get then first, we're going to get a labor supply schedule. Looks very easy. It's basically a constant elasticity of labor supply. It's a friction elasticity, epsilon F, and it's an increasing function of the real after-tax consumption wage. So this is 1 minus TH. This is the wage, and this is in a sense the marginal price, the marginal cost of utility per household age. There are some details there which are in the paper, which I will skip over here. Then the EASI demand system looks like this. So on the left-hand side, you have these budget shares, and they differ per household H and for commodity I. So we'll have 8 commodities I, and then there are about 1,000. Well, there are many more households, but say 1,000 households of different 1,000 different types of households. So these are the budget shares, and this is it's a function of indirect utility. And it's a polynomial function of the log of indirect utility function. It's a function of these log of these prices, and then here again these z's are the characteristics. So there are key characteristics of households. Are you single? Are you married? Do you live in a rented house? Is it an owner-occupied house? Etc. 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 I will show you that later. So once you know the indirect utility, so from here you can find this is the indirect utility function. So the indirect utility function, WVH, is a function of income and total expenditure of households, YH, and of all these prices. So we can put this indirect utility function to that, and then we get the budget shares equations we estimate. So that's what's given in equation 5 prime. We estimate those, and then we get our things. I'll show you in a minute what it implies. So all I want to say, it's very general. You have this big polynomial form. It captures lots of other demand systems as special cases. For example, the AIDS demand system, and is therefore very, very handy for applied work. The budget shares add up. The system automatically satisfies Slutsky symmetry, and they have to have adding up constraints because all the budget shares have to add up 1. So they This is the Slutsky symmetry conditions. Aij is Aj. So if you look at those coefficients here, Aij, Ajj, and Aij here, these are the Slutsky symmetry coefficients, and so we estimate those. And they all have to add up one, because all the budget shares have to add up to one. Corresponding to that system, there is an ideal cost of living index, if you want the Higgshian price index, and that's given by this term up here. Again, we estimate that as well. So that's the technicalities. If you want to read more about it, go to this Pendecourt and Lubel paper, the JPE. The government is fairly standard. These are the prices consumers face without taxes. Pi is the carbon tax, and EH are the carbon intensities, the emission factors, if you want. And then the government basically has a government budget constraint. So it has a revenue requirement R. These are the costs of the transfers of the dividends to the people. If you recycle some of revenue as dividend, there it is. This is the income from the carbon tax, and this is the income from the income tax revenue. In fact, we're going to use a scaling factor called lambda, by which you're going to have an across-the-board reductions in the income tax. So we're going to look at the effects of a carbon tax of 100 euros per ton of CO2, and allow, so that's pi, and then we allow, we either send it back to the general budget, or we give a lump sum transfer, or we cut an across-the-cut board lambda in the income tax reductions. And the total emissions in the economy are like that. So that's our model. There's one more thing you need to know, and that's, we will talk sometimes about the welfare measures. So don't look on the equations, but it's basically, if this is the expenditure function, then you're basically, it's perhaps easier to say it if, so basically it's the expenditure function at the initial policies, and then you're comparing it with the expenditure at the new policies, including the transfers they may get, and then to finance the original bundle. So maybe it's better to say it like that. So I will show you those equivalent variations, just like you get them in 101 microeconomics later on. So here are some of our estimates, and then I will do those exercises of these equations which I just showed you above. There are eight types of goods. So heating, transport, you name it. 8 characteristics: single or non-single, whether you're younger or older than 65, whether you have 0, 1, or 2 children, or other types of children. We control for heating type, we control for age, size of the dwelling, community size, and we also control for the gender of the household head. So there's a lot of controls, otherwise you don't get it right. But if you look, for example, at the transport line, these are the budget shares. They are not constant, like in a Cobb-Douglas utility function, it'd be constant. They're highly nonlinear. So you see that heating and transport, they're on the whole, they're the biggest part of the budget for poorer people. So that's why poorer people are hurt relatively more by carbon pricing, because they hurt transport and heating relatively more. And then the rich, then the transport, the share of the budget share of transport almost goes to 0. So here you see the total expenditure quarterly. So this is 10,000 euros. And then the richer the people get, the less their budget share goes on that. So if you look here, we have a few more. We have food going down, housing going down. So these are mostly consumed by the poorer people relatively more. But if you look at all the other things, the durables, they're consumed relatively more by the rich households. So that's the first thing we see. Another way of looking at it is at angle curves. So angle curves plot these expenditure things. These are like the expenditure on something, not the budget share, but expenditure against total expenditure. And then you see they go up, but they are not linear. They actually, in fact, they are concave, and they vary very much from one type to the other type. So we capture those as well. Here for services, here for transport, and others and durables. These probably make more sense to you. So, oops. So here we have the uncompensated price elasticities, both for the first quartile of the income distribution and for the fourth quartile of the income distribution. So the top one are the uncompensated price elasticities for the poor households, and these are for the rich households. So what you want to see is, if you look along across the diagonal, they're all kind of less than 1. So all these elasticities are less than 1. They're inelastic commodities. And that's even true also for the rich households. And what you see, there are all these cross-price elasticities. So I will try to suggest some of that. So all own price elasticities are less than 1, except for other commodities and services. So I already showed you those other commodities and services are consumed mostly by the rich. So this is also why they have higher price elasticities. But if own price elasticities are less than 1, they have few efficiency losses. And they're although they're very inequitable, they're good sources for, they're very efficient ways of raising revenues. So that means that households that spend a large part on these goods carry a large part of the tax burden. If you looked at elasticities for electricity, heating, and transport are a bit larger for low-income households than for rich-income households. So that means that the vulnerable households will cut back if consumption is taxed. And then if you look at the cross-price in the elasticity, so looking for food, housing, electricity, then if you look, like for example, food, and you look at heating, so let me do it again. So if you look food, and they are meant to be, food is here, uncompensated minus 0.65 and minus 1. Electricity minus 0.11, minus 0.18. So they're both the same sign. They're both complementary. I'm looking at the uncompensated price elasticity. So if that's the case, so the cross price elasticities indicate that food, housing, electricity, and durable goods are complementary to elasticities. So that if you're taxing one of them, then the demand for the other one goes down as well. Then the bottom table gives you those income elasticities or total expenditure elasticities for the first quartile. And then you see that they're all mostly, for both the first and the fourth quartile, incidentally, you see that they're mostly less than 1, except for services and durables. This is what I already said. So you see they're less than 1. This turns out to be crucial in the way we're going to recycle carbon tax revenue. So now let's say a little bit about emissions. So these are kilograms of CO2, and emissions intensity, which are kilograms of CO2 per amount of euro spent. So that's due to quarterly consumption across the household distribution. So the footprint data is provided by the German Central Statistical Office following the KOICOP classification, and basically use an input-output approach to estimate it. So what you find is the main thing when you look at these diagrams and you eyeball it, that you find that the overall emissions increase with income. So rich households have a larger footprint. But the interesting thing is that richer households have a lower emissions intensity. So why is that? Maybe a richer household has a more energy efficient car. So although they emit more energy in total, they emit less energy per money spent. So they have better insulated houses, rich people. They have more fuel efficient cars. Whereas the poor people have older cars and have less fuel efficient houses. They have not so good insulation. So that's why overall emissions increase with income, but emissions intensity fall with income. Again, that's crucial when you're thinking about recycling. That suggests that transferring €1 from a poor household to a rich household would actually decrease overall emissions. I would like to let you know that we allow for scope 1 and for scope 2 emissions. Scope 1 are the direct emissions of the firms, and scope 2 are the indirect emissions resulting from the materials you might import from abroad. Anyway, we'll show that later. So this is another way of looking at the table. I don't think we need it, but so we're excluding scope 3 emissions, which are the stuff embodied in imported intermediate goods. So what we include are the direct emissions and the indirect emissions. So if you're using electricity, then the electricity company is using emissions, and we are ascribing that scope 2, and so we're looking at scope 1 and scope 2. And So that's you see that there again in that table, the same as the graph. So we did that. So here's our estimate of labor supply. So we see that we look at this column, the wage elasticity about 0.381. It's about, we tried for different one for males and females, and females is a bit higher. So males about 0.2, females about 0.6, but this is what we're using. And we are allowing for the fact that rural households supply a little bit more labor, and there's some effect single, it's a bit less. So anyway, this is our labor supply schedule. This is what the tax system looks like in Germany. So that's the average tax rate. You see that's for singles, and this is for couples. The gray line is our approximation, which is pretty good. And this is the marginal tax rate, so we missed that kink. But that's what we're playing with. That's what we're going to look at. So you see that the marginal tax rate goes up quite a bit, around 50, and reaches a peak around 100,000 euros per year. Then you look at the residual income progression. It doesn't change that much. So this is the thing that the OECD reports. This is the percentage change in the after-tax wage with respect to the percent for a 1% due to a 1% change in the before-tax wage. Is this about? So here it is. This is our first exercise. So let's look at so now we're doing the policy simulation. So let's look at a carbon tax of 100 euros per ton of CO2. That can finance a transfer of 843 euros, or alternatively, it can allow for an income tax cut of 20%. So if you look at it, at this diagram, or you can do nothing and just say that the government keeps the money of the carbon tax revenue. So if you then look at emissions, then emissions go down in all three cases. So first thing is the emissions, the cut in emissions depends on the way you recycle. If you recycle via lowering income tax, the fall in emissions is smallest. Why is it? If you use the revenue from the carbon tax to lower income taxes, you're boosting the economy, you're boosting labor supply, you're boosting economic activity, and therefore you're boosting emissions. So that's why this 412 is only minus 5% reduction in emissions. If you don't do anything, the reduction in emissions is 11%. That's quite a lot. If you hand it back via carbon dividend, via lump sum transfers, well, then although you're not changing relative prices, you are making households richer. So they will spend on the whole more, and therefore by spending more, they will also emit more. So that offsets some of the reduction in emissions due to the carbon tax. So that's the first thing to notice. Then you see that my story I just told you is corroborated by this column. So that when you look if you use the carbon tax to lower income taxes, then labor supply goes up by 3%. Whereas if you do the other two, labor supply is reduced. So that's that if you use transfers, it makes people lazier. If you use income taxes, it makes them want to work harder. So that's the reason why in the case when you're doing a carbon tax, if you refund it via lowering income taxes, actually total household consumption goes up by 7.4%. If you do it by giving it back via transfers, surprisingly, it still goes up but by only 1.7%. And if you don't hand anything back, not surprisingly, of course, consumption goes down because you're just taxing people more. So ideally, you want to use a combination of these instruments. So if you look at this graph, you see that the bigger the transfers you give to people, so the maximum transfer is 843, then you can have bigger tax reduction. So if you don't have a tax reduction at all, if you don't have a transfers at all, say 0, then you see that 20% is where the line starts is your tax reduction. The bigger the transfers you give, the bigger the transfer. So let's look at it here. I think I've done this already. We can do this. So if you look here, now I want you to look at the welfare effects. So these are the welfare effects. So I want you to, these are equivalent variations in euros. So, and these are different ways of recycling. So I'm not doing a social aggregating welfare yet. I'm just looking at the utility of every household in the sample. So, and I'm looking therefore, I'm trying to get what is the majority support for. So if I use the carbon tax of 100 euros, to lower income, just look at the three panels on the left, not forget the right panels on the right. And then if you lower the income taxes on the left, if you reduce the carbon taxes to lower income taxes, you see that poor people get a bit worse off, but all the rich people get a lot better off. All these rich people on the bottom, you get all the income, gross income. So all those guys, 100,000 euros, 80,000, 60,000, they love it. Say, bring it on. I love carbon taxes, just because it was if you use the lower income taxes across the board, we're better off. Whereas if you have a carbon dividend, if you use the carbon tax revenue to hand out transfers to give a dividend, then there's a whole cloud up here. It's quite a lot. You can't see it. It's a huge weight. They're getting worse off. So this means that they get worse off. I'm not saying it. I'm saying they get better off if they're poor. These guys are getting better off. The poor guys get better off, but the rich guys get worse off. Whereas here, the rich guys get better off. So if the problem with handing it back as transfers is that the poor guys get better off, good, but then all those middle income guys and higher income guys, they get worse off. So you really have to wonder, do I want to put all my money of the recycling the revenues into kind of handing them out as dividends, or do I want to use a combination of them? And of course, if you don't do anything with the money, if you just everybody gets worse off. It's all below zero. Everybody gets worse off. So can we learn something from these clouds? So let's look at it. So I'm going to look at it again. So let's now look. If you look at the percentage of the carbon revenue recycled as transfers, then if you go from 0 to 100%, then look at the green line. You can afford a higher transfer. So this, but then you can afford lower and lower income tax reductions, 20% even. If you go beyond this point, you have to have an income tax increase. But here the transfer is so high. If you go beyond here, the green line is much too high, that therefore it's counterproductive. And then you have to raise income tax in order to be able to finance such high transfers. So you don't want to be here. And then if you look here, the orange line is labor supply or hours worked. The more you recycle as transfers of the total revenue, the higher the percentage, the lower the level of the economy, the lower of hours worked. And therefore the blue line is emissions, the less emissions. So what you see is the more you recycle as transfers, it's good for equity, it's good for emissions reductions, but it's bad for labor supply and it's bad for government revenue. So we have to do a trade-off between equity, efficiency, and environment. So here's what we try to do. So these are these measures already. I told you this is a different way of looking at it. This is where the households are getting better off if it's refunded via lowering income taxes. All the rich guys get better. If it's refunded via transfers, only the poor guys get better off, and everybody gets worse off if it's refunded. If it's not refunded at all. So now let's look at this diagram. Now this looks a lot better. So I want you to focus attention on this orange line. This is the weird one. So this is what we just looked at every individual in the sample. So there are tens and tens and tens of thousands. And then we say, are they getting worse off or are they getting better off? If they're worse off, we count them. If they're better off, we don't count them. And then we found that if you do the transfers are zero, we get about 55%, 50% highest. So the maximum political support is around. Here it drops off a lot. If you give a transfer more than 500 euros or so, 550, the political support really drops off. Loads of people get worse off. This is the type of diagram I want to show to my minister to my prime minister. And then I would argue, look, the best thing for you is to go somewhere here, give a transfer of like say 520 euros, and maybe then an income tax reduction of about 7 or 8%. So that's what I would do. And then if you look at it here, you can actually split it up if you want. If your minister is from a particular political party, maybe they represent the rurals more than the cities. So then the rural one is up here, and this is the total one. Then you can look at the composition of people, how much people, the percentage gain of the total population, and you can look at it like that. But this is the main thing I want to show, this orange line, that we have to look at political support. So another way of looking at it is like this. So now, What we've done now is we've taken a fixed €100 per ton of CO2 tax, and look, we've looked at all these different effects on welfare of all the different households, and then we say which one maximizes the political support. So this is more than 55%, 75% of the population supports this policy. Well, that's something I can go to. Whereas typically we might do an optimal policy, which is somewhere here. And then it's only 35% population supports it. Then no prime minister is going to accept it. So I'm arguing that, yes, we can look at optimal policies like a Bergsonian welfare function, but really what we're really interested in is maximizing the political support. And that's what I'm doing here. But now let's, for the sake of comparison and the sake of argument, now look at optimal policy. So what I'm going to do here is let's look at optimal recycling, and I mean socially optimal recycling. I'm going to maximize an Atkinsonian welfare function. I'm going to take an Atkinsonian concave transformation of every welfare function and of every utility function, add them all up. So that means that concave transformation has a constant measure of inequality aversion, relative inequality aversion, which is given on this axis here. So this is really an exercise in not in political economy, but in redistributive ethics. So what I'm going to look at is then if you increase inequality aversion, you go down this axis in the left panel, then you see that the total transfers go up. Yeah, so the more inequality averse the government is, say the more left-wing the government is, the more they want to spend on transfers. Look at this diagram, but also the bigger the carbon tax. So they're using the carbon tax as an efficient way to cut inequality, because it generates so much revenue, so it allows for even bigger transfers than they could have done otherwise. So here, if the inequality aversion is running around here, these transfers are much higher at €1,500, and they're partly paid for by having a very high carbon tax. So maybe even €120 per ton of CO2. Whereas if you're looking here, if the inequality aversion now goes the other way, just to make the diagram look clearer, if you now look at the effect on the income taxes, you see that the higher the inequality aversion, then you're using, so more left-wing governments don't like to cut the income tax rate. So the income tax reductions are much less. So what you see is that left-wing governments with a high degree of inequality aversions don't like to go for lower income taxes. They like to go for higher transfers. And incidentally, they want to go for higher carbon taxes, because that's the best way for them to cut emissions. It's the best way for them to deal with their equity concerns without being too inefficient. So that's what these diagrams show. Now we do something else. So this diagram was for a given carbon tax. So these we haven't looked at the optimum carbon tax yet. So this shows the effects for different levels of inequality aversion and for different levels of the carbon tax. So I didn't say it quite right. So if you have an inequality aversion of 1 and a carbon tax of 140, this is your outcome. So these are the exogenous variable, the carbon tax, and so we used to have a €50 carbon tax, and then you can read off what, with a given inequality aversion, what is your optimal transfer and what's your optimal income tax. So this is a second best optimization, where you're optimizing both only the recycling, how much spent on transfers and how much spent on income tax reductions for a given carbon tax for a given degree of inequality aversion. So the higher the exogenous carbon tax, the higher the amount of transfers you want to give, and also the higher the income tax reduction you want to give. So if you're prepared to set a high exogenous carbon tax, which is higher than say maybe higher 120, then you want higher transfers and a higher income tax reduction as well. But let's now look at the first best optimal policy, where we don't only optimize the optimal recycling, but also optimize the optimal carbon tax. Now, my apologies for this strange diagram, but I'll try to explain it. Again, so now the only exogenous variable is the inequality aversion. So this shows you going from right-wing utilitarian government to more left-wing governments. So look at the gray line first. So the gray line shows you how much income tax reductions you have. So the more inequality averse you are, the bigger the income tax reductions. That's basically what you want to see here. So if you have more inequality averse, you get bigger income tax reductions. Whereas if you get, I said it wrong. If you're more inequality averse, you get bigger transfers and lower income tax reductions. But that's what left-wing governments do. Right-wing governments going to the left have higher income tax reductions and lower transfers. So more to the left, it's less equity. Here is more equity. If you're on the left, so you're right-wing governments, then you have high transfers and low income tax reductions, typical right-wing policies. But now look at these optimal, the blue lines. Look at the numbers. So these numbers are the optimal taxes. So the more inequality averse you are, the more left-wing you are, the higher the carbon taxes. So this is a green left policy. It's like the Greens are left-wing as well. So it's not a green right policy, it's a green left policy. So the more left-wing you are, the higher your optimal level of carbon taxes. In this example, the Pigouvian carbon tax is set at 100 euros. So they go way over and above. If you're left-wing enough, you go way over and above the Pigouvian carbon tax. So what I'm trying to show here is if you do the political economy, where you looking at political support and you complement that with optimal carbon taxes, you can, I think, have a good narrative for policymakers to look at. I haven't got the slides here, but normally we associate with these diagrams also these equivalent variations, so then you can see how it comes to that, but I left them out for not being too long. So the optimal level of the carbon tax rises with the degree of inequality aversion. That's wrong there. Under both, so here we actually did it for two types of demand systems. It's not due. So it's not due. It's not just due to the regressive nature. So the regressive nature of the carbon tax is dominated by the fact that it's an efficient way of raising carbon taxes. So yes, the carbon tax is regressive, but it's much easier to offset it by giving transfers, even if you have to lower income taxes a bit, if you have to forsake lowering income taxes a bit. So then therefore you can actually offset the regressive nature of the carbon tax, and that's what's going on. So how much more time have I got left?
If you want 5 minutes, yes.
Okay, I'll do a few more minutes. Thank you.
Yeah.
So you can do other things as well. So if you go back to the original exercise, I think what may be more reasonable, what my prime minister said, he said, look, I don't care about these emissions. I want to have a 10% or a 20% emission reduction. I want you to show me what carbon tax I have to do. I said, that's very fair, isn't it? So we did another set of exercises. They're very similar, but it's a different way of framing it. So then we said, what do you need to do to get a 10% emission reduction? And then we did that with different recycling schemes. So now you should look at these three numbers. If you don't recycle at all, and you want a 10% reduction in CO2, this is typically the type of questions you get from your minister. Give me a 10% reduction in the next 1 or 2 years. Then we say, you have to put on a carbon tax of 87 euros per ton of CO2. It's quite substantial. It's about 4 times higher than the European level. But then if they recycle it, the revenue via lowering income taxes, then my answer is no, you must have a 212 carbon tax, 212 euros, much higher than 87. Now, why is that? Well, the reason is if you just saying a carbon tax is not enough. You have to say what you do with the carbon tax revenue. If you use the carbon tax revenue to lower the income taxes, you're really boosting economic activity. You see labor supply really goes up, consumption goes up, and emissions go up. So really, that's why you need to have a much higher carbon tax to offset those extra emissions. If you're doing it via a carbon dividend, if you recycle the revenue entirely via a dividend, you need a slightly higher carbon tax, because you know that a dividend also leads to higher spending, more emissions, and therefore needs to be offset with higher carbon taxes. So the answer, what carbon tax do I need for a certain 10% emission reduction, the first thing that my Minister of Finance, the Prime Minister, was surprised at, that I said, look, it depends on what you're going to do with it. And they were quite shocked with it. So, of course, the level of the numbers doesn't matter, but it's the story that matters. So, and then we showed, in this case, what they did like is the percentage of the households benefiting. This is, again, looking at political support. And we showed, look, if you give it all in terms of the carbon dividends, it's 32%. So you're going to get that, you're going to lose the election. If you do it by lowering income taxes, you get 53%. But in actual fact, even better is to do a combination of the two. You can lower income taxes a bit less and have more transfers, a higher dividend, and then you can still be above the 50%. So this is not the optimal level of recycling, but in terms of either maximizing political support or not. So you can do that as well. Then there's another thing what we did. So one of the things you could criticize our exercise for, and rightly so, is that it's partial equilibrium. Well, then public finance people would invoke things like the Diamond-Murley's theorem or the production efficiency theorem, and I say that's fine. But that requires a hell of a lot of assumptions. So some general equilibrium would not actually be that bad. I don't want to go into the assumptions now, but here what we did is, okay, let's make that those emissions intensity, we calibrated it by going to some integrated assessment models, and we looked at the production of electricity, the production of transport, the production of housing, and looked at the emissions intensity and made them endogenous. We made them an increasing function of the carbon tax rates. The calibration is in the paper. So that means that, of course, the effects are if you then have a €100 tax, for example, per ton of CO2, and you have endogenous emissions, the effects, you get a much bigger bang. So then emissions don't go down by 10%; they almost half. And again, they less so for if you use the money to lower the income tax, but still. The idea is, so maybe our original estimates were a little bit too pessimistic. You can get emissions down a lot more if you allow for more general equilibrium, if you allow for the fact that endogenous emission stats. So of course, another possibility which is wrong is that we have assumed that before tax wages are fixed. Well, you could argue that if you're lowering income taxes, then maybe wages will be cut a bit. Their wage bargaining power lowers down. So we need to allow for an endogenous. We've looked at labor supply, but we haven't looked at wage setting behavior. So if you did it in a more general equilibrium model, we would get better answers. So I say a mea culpa that we have not done it, but that's something we could do and we will do in future exercises. So finishing my last slide for this, the outlook for is political economy. So it helps to look at the percentage of the population gaining or losing, because that gives you some information about the economy of carbon taxation. But it conceals who specifically gains and who specifically lose. Maybe you want to compensate those who lose and forget about compensating those who win. So this vertical equity is really important. You need to really distinguish between vertical and horizontal liquidity. Now, many of you may know the Meltzer-Richards-Roberts model of income distribution, the political economy model. And there they say that in societies which are more, where incomes are more equally distributed, then the median voter is likely to be to be richer, and therefore to vote in favor of. Let me put it the other way around. The Meltzer-Richards-Roberts model is as follows: if there's a lot of inequality, the voter is likely to be a poor one, and therefore they're going to vote for very high capital taxes. So if there's a lot of inequality now, and you were to translate this, the paper has not been written yet, but then the median voter is likely to be poorer, then they are very definitely going to vote against progressive pollution taxes. So what I'm trying to argue is that we need to look at the political economy stuff, that we have to look at Guido Tablini's book and do more of these exercises, the book with Thorsten Persson. I already mentioned the Conrad-Haig effect, so I will do that, but then there's another thing. So one of the things we haven't done is overlapping generations. So Larry Kotlikoff and Kolfos in a recent paper in the International Economic Review look at 40 cohorts like of years of life, and then they do an overlap of generations. And then typically when you take such a perspective, whenever you do carbon, so they don't have income distribution like we do, but they have distribution, they have an income distribution across different age groups, different cohorts. And what they find, if you implement a carbon tax, that typically the cohorts that are currently alive will lose out, and those that will be in the future will win. So therefore, he's done a very complicated game theoretic exercise. It showed that all generations can be better off if you run up a debt and compensate the generations that are currently alive, the current young generations. So, and then the last point, I have a paper with Bas Jacobs on optimal taxations, and there where we show that, that the Pigouvian taxes and the optimal taxes really are hugely different if angle curves are not linear. We've shown econometrically that angle curves for these commodities are highly nonlinear, so that's something we should look at. But the last point must go to one of the best economists we've ever had in the world, who has died recently, Emmanuel Farhi, and he wrote a paper with Gabet coming out, or has just come out in Journal of Political Economy, and that's all about behavioral economics. We have this conundrum. Can we really, even if we do this political economy, as I'm suggesting, can we really assume that that will take away the yellow vest? And my answer, it's not. It's a bit like the weather. If you listen to the weatherman or the weatherwoman, then she or he might say it's 2 degrees outside, but your skin temperature feels it's like minus 20 degrees. It's really cold because of the wind or whatever. So the same thing is, I think, with a carbon tax. We can look at equivalent variations. We can feel how warm or how cold it feels for individual agents. But we know it feels just very bad. The skin temperature of a carbon tax is very, very high, and people say they're very worried. It's very, very low. It's freezing. They don't like. We don't want it. Whereas the skin temperature of a subsidy is much better. They have much more warm glow for that. So really, there's a new literature starting. Well, it's not really started. I'm saying it's something in my eye. I want to start it myself. But it's not started. I mean, it's done a bit in this paper, but not for environment. So where you want to say something like allow for the fact that people have different feelings about taxes and subsidies, and that then as Kahneman says, then the policymakers really have to take account of it, and then you get a truly optimal policy which takes account of all the aberrations and the strange quirks that behavioral quirks that people have. With that last thought, I would like to leave it, and I would like to conclude my seminar. Thank you.
Thank you. Thank you, Rick. It's your very interesting seminar. I have to say that it's a big issue. So speaking about the green tax reform is a very big issue, especially also in Italy. Now we are restarting again to speak about this problem. Inside your paper, there is also a possibility to some suggestions about how to manage this, because I think as you has explained to us very well, it's a problem when you have to bear a tax, no? When there is a tax, because tax is perceived as something that is a reduction of competition, or is in your case is a reduction on has a different effect in poor and rich groups. I have to say that during your presentation, you have answered to some questions that I had in my mind. One of these was exactly on the variability of this carbon tax, because if I read, I have in mind now a paper of Metcalf on Scientific American, with very simple paper. There is this explanation on this variability that is very strong, because I can read that is between 121. The average in the US is 43, but there is in Poland is very, very low. So this variability is also taken into account in your because it's very optimal is assumed, but I think could be also country dependent or not. This is in my head now is in this because could depend. And And after, now I think that we can, I have a couple of questions. I suggest also to the participants, if they want, they can write some question in the chat or they can intervene. Okay, now I leave the floor to Simone Borghesi for European University Institute and and the University of Siena, and that I know that he has a question for you.
Hi, Rick.
Hey, Simone. Nice to hear you always.
Always a pleasure to listen to your presentations, so to all who is thought-provoking. And I have a kind of policy question. While you were talking, I had this idea in mind, which repeatedly came to my mind, and so I can't avoid asking you. There are a couple of sectors which you mentioned, also building and transport. And as you know, there is a heated debate right now on how to treat these two sectors from the European policy perspective. The debate, it seems to me, is about whether to have them included in the European emission trading system or not. And also,
which two sectors are you talking of?
Building and transport.
Oh yeah, right, yeah.
Yeah, I'm now referring mainly to road transport because aviation is already there. The maritime sector will probably be there, but what about road transport and building? And this is very delicate issue because of the reasons you were mentioning. Because you know, middle low income households spend relatively more, a higher share of their budget into heating and road transport. So as far as I can see, there are three options: having them into the EU ETS, having them with a separate ETS like the German one, which started this year with 25 euros per ton of CO2, or do nothing, basically, or continue as things are, or with national policies only. And I was in a seminar these days where this issue was debated, and I would love to, let's say, to have your skin temperature on this issue on carbon pricing of this specific sector. How would you suggest to treat them?
So I think this is an extremely important point. It's much more policy oriented than my paper, but I have a view on it. So I think building and transport is, of course, colossally important. And there are huge equity concerns because if only for the fact that many people, it varies from country to country. So like in the UK, many of the poor live in very badly insulated housing, and maybe in France as well. Maybe it's less so in the Netherlands or Germany. So it depends on the country where you are. But then of course you can do that things with carbon taxes and then kind of refund them. But I think the first thing which comes to mind is, if you haven't done it already, make sure that their houses get properly insulated, have a government launching customer role in trying to make sure that houses go on heat pumps rather than on gas. And there's a big role for government together with housing corporations. And in a sense, what we see in the Netherlands and in other countries is that sometimes it's easier for poorer households because they live in council housing, they live in social housing. And then it should be possible with governments, builders and building corporations to kind of launch a whole new set of housing for poorer people that are properly insulated, that are net zero. Basically, if you leave it completely to the market, it's never going to happen because they will always try to cut corners. So it depends very much in what kind of, if you still have these old-fashioned building, social building corporations, then that's of course great, like we have in the Netherlands. For transport, again, you know, it is really a question, not how much you use the car, but also what kind of car you have. So if you're in Italy and you're still using an AP, one of these little diesel things, of course that's terrible. So you have to kind of compensate maybe. If you say that's no longer forbidden, you have a horizon rule. I think that's probably more important than maybe just ETS alone. And then you say before 2030, after 2030, no diesel engines, no petrol engines, nothing like that on the road at all anymore. You have to compensate the poorer people in society who can't, who will maybe still stuck with an old machine. And then on the carbon taxes, I think yes, they should be in just like all the others. But although I'm a big fan of the ETS, I think it's much too low, the price. So I typically advocate countries to have a top-up tax as well, to make sure that you take it from 20 to about 80 or 60 euros per ton of CO2 and then commit to it, to a rising percentage. But of course, very few countries do it, apart from Sweden and maybe Norway.
Okay, thanks a lot, Rick.
Thank you, Simone.
Okay. Now we have 3 questions, and now I invite Ilinia to send to you by chat, so you are able to see.
Okay, question 1. The modeling assumes. Okay, I will read the question. The modeling assumes an economy where CO2 emissions are due to households only, and these sectors of the economy activities account for the major part of CO2 emissions and other environmental impacts of a nation inventory. The point is that currently households already pay high energy taxes while companies pay much less. The main distributive effect of introducing a carbon tax related to household company equity. How much is your modeling conclusions constrained by the non-consideration of external costs in assessing the optimal tax level? I think that's an absolutely fantastic question. So one and very much to the point, and it's a very fair criticism. So we only look at households. So our paper must be seen as a methodological paper, whereas we are not looking on the firm side. So really, that's what I tried to say, that maybe we should have a general equilibrium model where you should look also at taxing when the firms are in there, and because they're the majority part of the emissions. So what we see now also in the ETS, that the largest firms get their permits for free. It's called grandfathering, and then some of the smaller firms and the middle-sized firms and households, they're the only ones paying the tax burden. So that's reflected in your question, and I think that's correct. So I think in future exercises, I would try to build on this to look on the production side as well, and look at exactly those things you're mentioning there. Of course, a lot of my other work has been exactly on the production side. Also, when I looked at fossil fuel producers, big firms like cements and steel and things like that. But here we decided to focus on households to get a start to go. Eventually, I don't know, when I started economic modeling, I can say this honestly, this was in 1977. 1978, I got to know Richard Stone. So Richard Stone, a Nobel Prize guy, of the linear expenditure system. And there we had this huge model of the economy, like you've probably called an integrated assessment of it, 4,000 equations. But then all these demand systems and all these production side and all these export systems, all the import systems were part of the model. I don't know how well the demand systems are part of the integrated assessment model. So the few that I looked at is, so it's really what this paper is, more some methodological suggestions for people who are working with these big integrated assessment models, where both sides of the general equilibrium feature is taken into account. But then you're talking about modeling teams, not 2 or 3 people, but maybe 10, 20, maybe hundreds of people. So thank you very much. It's a very good pointed question.
The next one, we have other 2 questions for a moment.
So thank you. But how exactly do you define political support for the tax reform? Is the implicit assumption that households support a policy if it increases their utility? Yes. So we took in a very neoclassical perspective there. So the idea is that these equivalent variations, they measure. You have what was the utility before the package and what's the utility after the package, and how much the equivalent variations, how much are they prepared to pay to avoid the package being implemented. So that's just like you do in microeconomics. But of course you could argue, is that the correct measure? Is that really what matters for political support? So this is what I said about the very last point of the seminar, the behavioral approach. What should also be included in there, it could very well be that you vote against your own interest. So I always vote left wing, but obviously I earn too much. So I should be voting for, it's not in my interest to vote for the parties I'm voting for. Maybe I'm doing that out of guilt, or maybe I'm doing that out of idealism or whatever. But the point that you say that it's just a first shot at the question. If you just look at everybody be better off, that may not be a guarantee for getting political support. It was just our rough way of getting at it, but it should be qualified exactly by that. So that's where the political scientists come in. I know from previous work that I've done on political economy that many people in well, some rich people or higher educated people start voting left wing, but because they can afford to vote left wing. So anyway, that's an open question. So I take that point very much. Thank you.
Okay, thank you again. And now the next and the last one is
most of the less affluent households have a zero expenditure for road transport. In general, we have a lot of zeros compared with heating and electricity. Do your system demand equation technique account for that? Yes, we do. Yeah, that's a very good, it's a technical point, of course, but we do allow for that. We typically have a Heckman type system where you first estimate are they doing it or not, and then once they've done it, once they decide to use road transport, how much do they do that? So yes, we do however badly or however, this is a serious problem. So we do try to use a two-stage estimation technique. Now, these are great questions. I hope I can copy them into before I leave. Yeah, thank you very much.
okay. Thank you very much to you. Now we can close. So I would like to thank you again. It was a very interesting seminar, very clear. As you have seen, a lot of questions. So it's very interesting for all of us. Also because, as I said, it's a very big issue. So Rick, I would like to thank you for this.
Thank you very much, and thank you. It's a pity I can't see anybody there, but there'll be times in the future where we all meet. Thank you very much.
You are formally invited for the future.
Thank you
very much.
Bye.
Thank you. Bye bye.
Bye bye.